Assalamualaikum and hi everyone. Welcome to Principal Malaysia's 2023 Quarter 3 Market Outlook. I'm Fartini and I'm your moderator for the session today. I'm thrilled to introduce our speakers, Mr. Patrick Cheng, CIO of Principal Malaysia and CIO Equities of Principal Southeast Asia, Mr. Jesse Liu, CIO of Fixed Income of Principal Southeast Asia, and Mr. Lee Chun Hong, Head of Equities of Principal Malaysia. Now, Patrick, it's been rather fascinating how the financial markets, especially the developed markets, are holding up well in the second quarter despite the uncertainties about recession, inflation, and geopolitical risks. The S&P 500 is up by 15% and Nasdaq is up by 30% year to date. So what's your take on it, Patrick, and why do you think that this is happening?
Good question. I think at the end of the day, the market rally has been very, very narrow, led by the Nasdaq. The Nasdaq, as you rightly pointed out, is up by more than 30%. But the backdrop to this is that I think people are starting to price in a milder recession, which I'm sure Jesse will allude to later on, right? And I do think at the end of the day, I think risk assets, particularly in the tech sector, have done very well on the back of one major theme, and that has been AI and ChatGPT. This whole phenomenon in the second quarter has derived a lot of optimism of the long-term trends in terms of AI, and as a result of that, the S&P 500 with the technology sector rebounding has led to the kind of rally that we talked about.
Okay, thank you, Patrick. Now, gentlemen, let's now switch gear to talk about fixed income. Jesse, amidst the ongoing policy uncertainties, I'm just intrigued to hear your insights on the future direction of the fixed income markets, given the recent decision of the US to skip the policy rate following the encouraging inflation data that points to a significant decline. Can you give some color as to how you anticipate this move will impact fixed income asset class going forward?
Okay. Glad to be back again. So I think let me just start off with giving you a high-level return perspective of the fixed income market. So this year, as we are looking into the dollar market, we're looking into the local currency market, all generally fixed income market has been doing well, largely because, again, we have been expecting policy rate setters to really consider pausing throughout the world, except for some countries around the world, maybe in Europe and in the UK. But generally, you have a lot more narrative that is talking about rate pause entering into second quarter. Now, having said that, the performance for fixed income has been quite strong throughout the year. A lot of it came from price action, given that there was some pricing in terms of the pause and the rate cuts in the US. And also similarly in Malaysia, there was a pause that was priced in. So generally all markets, that's why I performed quite well. Now, as to your question, where we are looking into markets moving forward, I think what we are seeing broadly is that inflation is trending lower and lower, but it's not trending as fast as where market participants want it to be. And that's where now you're seeing the narrative change slightly in terms of where that pause is going to come. Some countries are a little bit more certain in the sense that the central bank has committed to pause their policy rates, countries like Indonesia, for example. Some countries are really trying to find that sweet spot because inflation data seems to be quite sticky. For example, in the US, there were talks about rate cuts towards the end of the year. That has now kind of reversed, and that's where it caused a little bit of reversal in the month of May. So in that sense, I think the market is still overall, I would say, very bullish in that sense, because investors' mindset is not about multiple rate hikes. They're still looking at that kind of soft adjustment here and there in terms of policy rates. So I think my view is that there's going to be still strength in the bond market, and it's really part and parcel looking how the data is going to evolve, how fast inflation is going to come down, and how that would result in central banks' reaction function to those new data coming in.
Okay, thanks for your perspectives. So additionally, Jesse, based on that macro view, where should clients be putting their money in fixed income? Should they be investing in government bonds versus corporate bonds, or a combination of both, or principal bond funds, which are more diversified? Your thoughts, Jesse?
So as for asset allocation, bond assets in general, I think the first half of the year, if one were to position, it would be for capital gains because market is pricing in that rate cuts, right? As we move into the third quarter of this year, I think that rate cut narrative probably would simmer down. So in that sense, if I were to asset allocate the bond portfolio, we would want to position more into spread products, meaning corporate bonds, because it has a spread over the government bonds. So in that sense, I think alpha is much more likely to be generated from that angle rather than government bonds. In totality, if I look into the entire market, I think there are a few markets which are very interesting. I think Asia continues to be very attractive. Asia has done well. US dollar terms is up 3.8%. Malaysia is up about 4%-ish. So I think moving into the next half of the year, we are talking about, if let's say there's not going to be drastic changes in interest rate, so I think we can probably add a few more percentage points into the total return for the year.
All right.
Yeah.
Thank you, Jesse. Now, let's go back to Patrick. Patrick, let's talk about the Asia-Pacific region. At the start of the year, there was so much hype about China's reopening and the World Bank's growth projections for Asia. Now, furthermore, China's recent economic data has been uneven, and it looks like further policy support is needed. In your opinion, Patrick, what does China need to do to induce more sustainable economic rebound? And what do you foresee in terms of the Chinese equity markets?
So, as you rightly pointed out, I think the unevenness of the Chinese economy has happened after the first quarter, right? We reported basically a very strong number in the first quarter in China. But after that, you started to see a deceleration in terms of the manufacturing number, whether it's the Caixin PMI number below the 50th mark, consumer confidence has been much lower, the housing market also has cooled off a little bit. But those are things which are basically behind us. What we need to think about is the forward-looking, right? So in the last couple of weeks, what we noticed from the Chinese government as well as the officials down there is the sense of urgency towards pump priming the economy. And what really has happened is that, first and foremost, they have started to cut rates. The one-month loan rates have been reduced by about 10 basis points. That's a signal of more stimulus to come. Now, the key question to all investors out there is to ask yourself whether or not the Chinese government is going to allow this deceleration in the economy to continue. The simple answer is no. Why? Because they are just too big an economy for them to let it slow down, right? Property market cannot go down forever, right? It has to continue to burn. The manufacturing sector has to rebound. The focus towards AI and data, the tech sector has to continue. Policy making has to be pro-growth. And I'm hopeful by the second half of this year, particularly in the third quarter itself, you're going to see a lot more news flow on this front. On the back of this, markets are forward-looking. In the last 1 month to date, the H-share market has already rebounded by 10%. People or investors like ourselves have started to think about basically more stimulus coming in. Now, we want to see a follow-up towards this so that the momentum in the Chinese market will continue. And we are hopeful when they do that, people will start to reprice higher growth, higher expectations, and so forth.
Okay. Now, Patrick, my next question to you, besides China, are there any other trends that you observe that's propelling the rebound in Asia ex-Japan?
Yes. If you dissect the MSCI ex-Japan, 3 key markets basically stand out at the moment, right? Taiwan, Korea, and India. And to a certain extent, ASEAN as well, which I will talk about a little bit later, right? I think what has happened post this whole revival of the AI thing that we talked about from the Nasdaq point of view, right? The whole demand cycle is coming out, multi-year story and so forth. I think that has basically set itself up for a rebound on the tech industry in 2024. Markets, as you know, is forward-looking. So the Korean market, as you know, is derived by a lot of tech companies as well as in Taiwan. That has created a double-digit kind of rebound that we've seen, right? And the back of that as well is India is now being a favored market because of the fact that a lot of growth companies are continue to basically show up much numbers in the first quarter. We have just done a study. We just sent a team down there to look at the India economy. Because we're very positive on that. So I think when you think about Asia itself, you got to move away just from a very China-centric Asia to beyond a China-centric Asia. And on the back of that, you got to think about how investors need to allocate maybe a certain amount of money into one of my favorite regions called ASEAN, which I'm sure Chung Hong will talk about later. This is a region which I think a lot more investors are starting to look out for because they want to diversify away from China. China, as you know, yes, it's uneven and so forth, but people have put a lot of money in there, and people are now starting to think about where do we diversify away from China, right? And increasingly, I can tell you, honestly speaking, there has been so many inquiries, regionally, globally, and locally as well, to think about ASEAN as an asset, a very important asset class for investors, right? So I think that's something that investors out there need to think about.
So that leads us to Chun Hong. Let's now deep dive into ASEAN region. Chun Hong, ASEAN has been performing relatively well, but still lagging the broad Asia-Pacific market year to date. Are there any recent developments in the region, Chun Hong, that could potentially fuel further growth for the rest of the year?
Thanks, Martini, for the question. So yes, ASEAN has been relatively resilient, as mentioned by Patrick in the past, that ASEAN is a market with low volatility that performed well in the highly volatile market. But again, it is lag behind the peers, but at least because, like mentioned by Patrick, the rally has been led by all these tech and especially the generative AI team, which is ASEAN is lacking. But it's not to be negative about. Okay, as you can see that ASEAN is getting more inflow into as in the FDI investment into ASEAN space, like Indonesia, where there's a lot of investment into the H-Power facility that is key for the EV battery. And China, being the largest supplier of the battery, is at least setting up plant, and some of the plant are commissioning. And one of my colleagues are right now in that area to watch for the factory, how it works. And beside that, I mean, there is also a lot of FDI into the copper space and also the aluminum space. So Indonesia positioning themselves into electrification and so renewable energy supplier. And then moving to Malaysia, I mean, as you all know, that one of the largest conglomerate in Japan, Mitsui, just bought a 20% stake in one of the cybersecurity firm in Malaysia. And it ranked along with the Big Four auditor, the KPMG, the likes of Pricewaterhouse and Ernst & Young. So you can see that you can find gems in Malaysia as well. And so speaking to EMS company in Malaysia, I mean, inquiry has started to pick up again from the likes of Taiwanese, Korean or American company. So things are slowly coming back up, like what mentioned by Patrick. Recovery could be 2024, but we need to be forward-looking. Okay. So and also a lot of DG banks are being listed in Philippines, Indonesia, and Thailand. And the last market I would like to touch on is Vietnam. So my colleague just came back from that. He thinks that things has improved, and this is a market which is Patrick's favorite market as well, and start to show improvement in terms of the FDI and also the equity performance. And also, I mean, looking at the currency performance during these 2 months, one of the most aggressive central bank in the region that cut rates more than 100 bips in less than 2 months, yet the currency are behaving well. It shows that market are maturing in Vietnam, and foreign investors are actually getting more comfortable the way they manage the balance sheet in the country. So you can see a lot of things are improving. And lastly, to touch on the China side, I mean, once the recovery is stronger and the citizens in China start to move from domestic to international travel, then in this part of the region, as you know, the ASEAN is a beneficiary of the Chinese tourists inbound. So hopefully in the second half or first half of 2024, we can see the rebound, the tourism activity in ASEAN space. So things are start to improve again on ASEAN, and we expect that performance will start to improve going to a second half or even the first half of 2024.
Chun Hong, I've got another question for you. While the broader regional markets are showing signs of improvement, Malaysia's stock market has been a bit lackluster. Nonetheless, there's a silver lining in the small cap space, which seems to be performing rather well. Let's hear your thoughts on factors that could be contributing to this divergence. And what do you foresee for the outlook of the small mid-cap space moving forward?
Yes, I think you're spot on the front. You can see that, I mean, the big cap has been underperforming the small caps. It is also shown in our the product that we have, the small cap product fund, and also fund that focus a lot on the small cap are actually outperforming on the medium to longer term and year to date as well. So it's a function of the equity market. Equity market is all about growth, and where can you find growth? Most of them you can find through the small cap if you sift through and work hard enough to identify some of the key company that can generate the growth. And why large cap is underperforming? As you all know that large cap in Malaysia, the KLCI 30 are dominated by cyclical companies, the likes of banks, commodity-related base, and also downstream to the commodity. So, and not surprisingly, because Malaysia is a trading nation, so yeah, it's bound to have most of the index stock or large cap are dominated by all this cyclical. And you'll know that geopolitical tension has been rising in the past 2 years, and the external market or the developed market are entering a soft patch. So cyclical stock are generally underperforming in this space. So we need to sift through the market, look through the whole Bursa Malaysia. We can identify a few themes. Some of it, like I mentioned earlier. So one of it is the China Plus One strategy, renewable energy, electrification. Of course, the Internet of Things, and like I mentioned earlier, the cybersecurity that the Japanese bought 20% stake in. And of course, we can't run around away from this ChatGPT or generative artificial intelligence team as well. So we do have selected company, a few companies that will benefit from there. So yeah, that's why some of the fund that we invested in this kind of team are generally giving better return for us.
Thank you, Chun Hong, for your perspectives. Finally, I'd like to gather some insights from Patrick regarding asset allocation. Now, given the recent market dynamics, have you noticed any noteworthy shifts in asset class preferences? Additionally, considering the current situation, what advice would you have for investors in the near term?
Right. I think the biggest observation I've made is the fact that, first and foremost, people are definitely pivoting towards fixed income, right? Because of what Jesse has mentioned, yields have backed up quite a fair bit. And people are now starting to take a view, whether it's corporate clients, whether it's retail customers, whether it's banking customers, people are thinking about yield as a denominator for safe haven to park their money. The other side of the equation is for growth investors, people are starting to think about, for example, how do we then shift the asset allocation in equities towards Asia and emerging market and including ASEAN. I think the interest in Asia itself continues to be very, very strong on the back of China, but I also started to see a shift towards the ASEAN asset class, as I mentioned earlier on, for obvious reasons, right? It is a structural play on FDIs, it's a structural play on demographic dividends, it is a safe haven for a lot of the yields and leading stocks. But I also think at some point, right, and I'm sure Jesse will talk about it, is that people will also start to pivot towards the Asian bond space as well, which I think is very, very attractive in the Euro space, right? So all this combined, we think that if you had to be invested out there, I think you're going to be invested in Asia. Asia to us, both on equity and fixed income, continues to be very, very attractive. And I think there is never a better time to buy fixed income than ever before now.
And so before we end this session, let's hear from Jesse. Any parting words from you, Jesse?
So I think that for fixed income, it was interesting in 2023, largely because at the beginning of the year, investors were really looking at really de-risking in a way that there were a lot of flows into deposits. Where it became interesting is because investors tend not to see that fixed income do have risk too, but the risk is generally not as high as equity risk and it's interest rate risk. So in that sense, when you have a market where it's trying to price in rate cuts, that's where the gains came in. And therefore, on an annualized basis, if you look at fixed income indices around the world, they tend to have performed better than most of the fixed deposit products that you see in the market. So if I were to then look into the next quarter, even next half of the year, I think one part is that we look into the fixed income market, really looking at interest rates. And when we look into interest rates, we are looking really into a cycle whereby probably we are seeing a peak in interest rates. We can't really time it exactly to the point, but I think that is one risk that is, to me, is much more calculated in that sense for you to take some into your portfolio. So not only you will get the yield to maturity advantages of a bond portfolio, at the same time, you can take some of that risk if interest rate has peaked. You can take some of that risk, and if there's a rate cut, you will have another leg in terms of returns on the price of those bonds. So on a totality basis, fixed income will perform generally well in that scenario.
Okay. Now, on that note, I'd like to thank Mr. Jesse, Mr. Patrick and Mr. Chun Hong, for your insights and perspectives today. And to everyone watching, we hope that this quarter's Market Outlook has provided you with some valuable insights and information to help you manage your long-term goals. So thank you everyone for watching. Till next time, stay safe and be well.